if you have like hundreds of thousands or even millions of dollars, or if you're a bank or you're a really rich investor, you're not really going to buy GLD or SLV. Whereas in the SLV and GLD markets, the amount of gold and silver that those ETFs hold has not risen anywhere near its peak. That means the retail investors, both in the paper markets, in the people who buy GLD and SLV to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars.
In the context of a strong 2023 for gold, defying expectations in a high interest rate environment and outperforming various assets, including commodities and bonds, Rafi Farber, in conversation with Elijah K. Johnson, sheds light on critical market dynamics. Farber underscores the contraction in the dollar supply since April 2022, cautioning buyers about the broader economic context despite daily gold price fluctuations. He discusses the reverse repo market's uncertainty and potential consequences, expressing concerns about its sustainability. Simultaneously, as 2024 approaches, Farber reflects on the potential scenarios for gold, emphasizing the unpredictability of each economic cycle. Despite the market consensus anticipating a soft landing in the U.S., historically less favorable for gold, Farber points out unique factors such as geopolitical tensions and continued central bank buying that could support gold. In the face of uncertainties surrounding the Federal Reserve's ability to guide the economy and the looming possibility of a global recession, gold emerges as a crucial hedge, making it a noteworthy consideration for investors in the coming year. Now, we'll show you more clips of the interview with Rafi, but first, subscribe and turn on the notifications bell so you do not miss out on our interviews with the leading financial commodities experts. Enjoy the video.
Yeah, so I noticed that in gold and silver are moving. When we say gold and silver moving, we're usually referring to the spot price, the price that you see when you're looking at the gold futures or the silver futures, and they're at a high or they're at a low or whatever it is. It's the futures price that's referred to, and the open interest in the futures market has risen very fast. Whereas the ETF market, meaning GLD, if you have like hundreds of thousands or even millions of dollars, or if you're a bank or you're a really rich investor, you're not really going to buy GLD or SLV. Maybe you will, but if you have a lot of money, you're going to buy futures because that's where the leverage is, that's where the excitement is, that's where the real money is, and that's where you can actually get physical gold and silver if you're plugged into a brokerage that can deliver that future to you. And it's possible. I tried it and I got to a point, but I know that there are brokerages that do accommodate this. So if you're a big investor, that's where you will invest, and that's where the action is happening. Whereas in the SLV and GLD markets, the amount of gold and silver that those ETFs hold has not risen anywhere near its peak, which I think was in 2021 or early 2022. They've fallen since then. So that means the retail investors, both in the paper markets, in the people who buy GLD and SLV to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars. They're not really interested in the market right now. If they were, then we'd see the amount of gold that these funds hold go up, because that's what happens when more people are invested in GLD and SLV and they have to maintain their peg, like an informal peg to the futures market. Then they have to put more gold and silver into those funds in order to expand the share count, in order to keep the price level with the futures market. So the fact that gold and silver is the amount of physical gold and silver in those funds is falling means that the retail investors in those funds are losing interest. Also, in the physical market, we're not seeing that much.
Rafi highlights how gold price maintains a subdued buying tone during the early European session, nearing the upper limit of the recent trading range. The US Jobless Claims for the last week of November have risen to 220,000, signaling a weakening trend in the US labor market, as previously anticipated by JOLTs and ADP readings, possibly prompting the Fed to consider rate cuts in March 2024. Confidence grows among investors that major central banks are concluding their tightening era, preventing a significant downturn in gold prices. Anticipation of rate cuts, potentially earlier than expected, is evident as the Fed's monetary policy meeting approaches, with a 50% chance priced in for rate cuts starting in March next year. The Bank of Canada, BOC, and the Reserve Bank of Australia, RBA, hitting the pause button this week aligns with the perception that tightening cycles are concluding. Like and subscribe to get more videos like this. In the continuation of the interview, Rafi talks about how the market emphasizes the impact of hopes for rate cuts and lower U.S. yields on supporting gold prices. Investors are closely eyeing Friday's non-farm payrolls, with a downbeat reading potentially boosting expectations of early 2024 Fed rate cuts and driving gold prices higher. Moody's warning on China's debt credit rating contributes to a safe haven appeal for gold. Despite the US dollar pulling back, technical analysis indicates gold prices trading within a range, seeking direction but facing resistance below $2,040. The longer-term bullish trend from early October remains intact, with immediate resistance at $2,040 and key support at $2,000, while a break below could lead to bearish pressure towards $1,950 and $1,932.
That fits with the data that I'm seeing, because I'm seeing a lot lower premiums in the physical market. Still a lot higher than average if we go back all the way to 2008, a lot higher, but a lot lower than has been recently, let's say since Silver Squeeze. So we're seeing a lot less interest in the physical market, a lot less interest in the paper market for retail, and a lot more interest in the futures market, in the primary derivative that leads all the other derivatives, like in the ETF. So we're seeing something start, right? And this is probably going to be followed by a financial crisis, which is might bring the spot price down in some kind of crunch, and then the Fed's going to act, and it's going to go boom, just like it did in 2008 and 2020, just a lot faster this time.
What should people be thinking right now? Obviously, we're seeing a lot of volatility in gold and silver, but those holding physical metal, a lot of people aren't there to trade the metal, right? If you're a trader, that's one mindset you can have. But if you're just holding the metal in your own possession, these price fluctuations shouldn't really have much of an impact. But what is your perspective on that?
They shouldn't, as long as you're not leveraged. And this is what I say all the time. Like, if you understand what's going on in a broad sense, and the day-to-day movements are disturbing you, just like stop looking for a while. And I say this to myself also. Like, I'm also a victim of it. It's axiomatic that gold and silver are the money, and and the dollar is just a derivative of that. So if you own the physical, it's not that easy to pick up your physical stuff, which you have to like take into a car and carry physically, and move to a coin shop, and then sell to them. Most people are not going to do this. People who want to trade gold and silver are trading GLD and SLV. It takes a button to click, and that's it, and it's done. And we already know from the numbers that we just discussed that they're not interested anymore. So look, there's going to be one more round of printing, and this is my opinion. And there's going to be one more round, because there's going to be one more financial crisis. It's going to be more extreme than 2008. It's going to be more extreme than 2020. And when it happens, the spot price of gold and silver is going to go crazy. I don't know, $2,500, $3,000 in a few nights overnight. I don't know. I'm just putting out numbers, but it could be that extreme. And when that happens, then only after that are you going to see people in the physical market start to get more interested, right? And it's gonna happen quickly, and then you're gonna see premiums go up and up and up, and you're gonna get calls off the hook, and people affiliated with different gold companies are gonna get calls off the hook. We're looking forward to that, and the danger is like maybe at the point where you say, someone who sells gold and silver, like, I don't want to sell anymore, I'm just because I don't want the dollars, then we'll know that we're in the end game. When gold and silver physical stocks are no longer for sale from people like you and me, that'll be it. And so we'll know, we're like sort of the operators of the end game in that sense, not to put us in like a pedestal or something, but we're just the functional operators of it because we won't be able to sell anymore. And I think that's next, because I think the next printing round is going to be like something like 10 trillion, $5 to $10 trillion. And what's the difference between 5 and 10 trillion, It's going to be that extreme, and it's going to be that devastating for dollar holders, and it's going to be a big wealth transfer for gold and silver holders. And if it's physical, no one can take it away from you as long as you have it, hidden in a place where the government can't take it from you. And not to encourage anything illegal, but just be smart.
Thanks for watching the video till the end. Post in the comment section your opinion on today's show, as it's very important to us to know your honest opinion on the matter. And I see you on the next one.